Hey, so in this vid, I'm gonna tackle the scenario where you're forming a new business and you want it to be an S Corporation, and the question is that formation process and electing S a taxable event? And I think the first just caveat I would say is I'm not going to get into the requirements of what it takes to be an S Corporation, whether your entity qualifies or not. I would reference you back to my other articles and videos. I have other videos on S Corporations where I address some of those criteria, so take a look at those. I'm just going to talk about the formation transaction itself. And when you focus strictly on the formation, what you're really asking is forming a new corporation a taxable transaction? And the tax rules that apply in that case are not unique to S corporations. They're actually the same tax rules that apply to C corporations. That is, the question of whether forming the entity is taxable or not is actually the same question whether it's a C corporation or an S corporation in most cases. And that discussion assumes that the path for you becoming an S corporation is to first incorporate your business under some state laws and then make the S election for federal income tax purposes. The process of incorporating is considered to involve an exchange. A lot of people don't think of it that way, but when you file articles of incorporation with the state government, the new corporation is issuing the owner's shares in exchange for something. And what the shareholders are often contributing is cash, but they could also be contributing other property, non-cash property, or they could be contributing services for their shares of stock. When we consider the possibility that founders are contributing non-cash property, what I mean by that would be tangible stuff like furniture or inventory or maybe even real estate, although that's not something we would recommend for other reasons, but could be, right? It also could be intangible items like intellectual property or I'm thinking patents or copyrights or contract rights or things of that nature. When a new shareholder contributes cash in exchange for stock, that transaction should not be taxable. So they're just putting cash in, they're getting stock back, it's a fair trade. Generally no taxation to that kind of transaction. But on the other hand, if a shareholder is contributing services to a corporation and you're getting back unrestricted, just flat out shares of stock, that transaction is always taxable. So the stock received, you have to determine what the value is, and it would be based on the facts and circumstances of the services being provided and what the then assumed value of that stock was. So essentially, it's just viewed as the stock you receive in that kind of deal for services is just viewed as compensation for the services. So if you provided a service and you would receive cash, it's taxable. If you provide a service and you receive stock, it's also taxable. A lot of people don't realize that or assume that, but that is always the case. What could be a question in that case is what's the value of that stock, and that's where your fudge factor may be in trying to make an argument that the value is very marginal in order to minimize your compensation. But I'll leave that for some other video. So what about contributions of non-cash property? Well, these transactions may or may not be taxable depending on whether the shareholders qualify for special tax deferral on exchanging property for stock found in the code, in the Internal Revenue Code, in the Federal Tax Law, Section 351. This special rule requires that shareholders are going to be part of a group of shareholders that controls at least 80% of the company's vote and value of the stock after the transaction. Only certain types of stock that don't have the features of debt would qualify for this. Generally, that's common stock and sometimes certain kinds of preferred stock. On a simple company formation where all the founders are contributing cash or property for stock, then the shareholders should qualify for this special rule under Section 351 because you're part of the group that's founding the company, so your group owns 100% of the company after it's done. It's not about whether you personally own more than 80%, it's whether your group does, and since you're one of the founders, your whole group owns 100% after the formation. This rule that I'm talking about, Section 351, does have nuances and pitfalls that I'm not going to completely cover here. I'm just throwing it out there that when you form your corporation and you contribute property, it's quite possible that you can not have a taxable transaction. In summary, if you form a corporation under state laws and then you elect S for federal tax purposes, the formation should not be taxable if the shareholders are just contributing cash. The transaction will probably be taxable to some extent if the shareholders are contributing services, and if the shareholders are contributing property, tax may be avoided if shareholders qualify for Section 351 treatment, which they often do. Well, that's it for this video. Keep watching. I hope you're getting something out of it. It's great for me to be able to take a break from gardening and do this at the same time, so thanks for doing it with me. I'll see you guys later. Bye.